What happened in the early morning hours of January 2nd and 3rd, 2026 has sent shockwaves through global commodity markets, and the implications for gold and silver could be absolutely massive. And if you've been following the news, you know that the United States just conducted a large-scale military operation in Venezuela, capturing President Nicolas Maduro and his wife. They've been flown out of the country, and what followed at President Trump's press conference has me more concerned about market volatility than anything I've seen in my decade-plus of analyzing precious metals. Today, I'm going to break down exactly how this geopolitical crisis will impact silver, gold, and other precious metals prices, why the supply chain disruptions could be far more severe than most people realize, and what this means for your portfolio as we head into what could be one of the most turbulent periods in modern commodity market history. Let's dig into the data. First, let me give you the facts, because there's a lot of speculation flying around right now. In the overnight hours of January 2nd through 3rd, U.S. military forces conducted precision strikes in Venezuela. President Trump confirmed the operation on Truth Social, stating that Maduro and his wife were captured and removed from the country. The operation involved both U.S. military and law enforcement agencies. At a subsequent press conference at Mar-a-Lago, Trump revealed several critical details. U.S. forces caused a blackout in Caracas to support the operation. No U.S. personnel were killed and no equipment was damaged. The United States will maintain its oil embargo on Venezuela. American oil companies will enter Venezuela to repair infrastructure. The U.S. will remain strongly involved in Venezuela's oil sector during a transition period. An occupation is planned, with U.S. officials essentially running the country for approximately 1 year. Trump was remarkably open about the strategic objectives, particularly regarding Venezuela's oil reserves, which he stated had been stolen from us. He indicated the infrastructure would need to be rebuilt and that this would take considerable time. So what does this mean for commodity prices? Market experts are anticipating a gap-up opening for crude oil, silver, gold, and copper when markets fully resume trading. Let me explain what a gap-up means for those newer to markets. This is when a commodity closes at one price level, then opens at a dramatically higher level without trading in between. We're not talking about a gradual rise. We're talking about an instant repricing that reflects panic, uncertainty, and scrambling demand. According to multiple market forecasts, COMEX silver was at $72.77 and may trade near $75 to $78 per ounce. COMEX gold closed at $4,345.50 per ounce and could move to $4,380 per ounce. Brent crude oil may move towards $62 to $65 per barrel. Now, these are conservative estimates in my view, because what happens when markets are closed for an extended period during a major geopolitical event? Anxiety builds, uncertainty compounds. And when those markets finally open, especially with Sunday night pre-trading in Asian markets, you often see emotional buying that drives prices far beyond rational expectations. Here's where things get really interesting for silver specifically. The U.S.-Venezuela crisis has jeopardized the sea routes that Peru and Chad use for their silver exports. Let me break down why this matters so much. Peru is one of the world's largest silver producers. Chad also exports significant quantities. Both countries rely on shipping routes that pass through or near Venezuelan waters in the Caribbean and along South American coastlines. With U.S. military operations ongoing, with the potential for second-wave actions if there's resistance, and with Trump confirming an extended occupation, these critical shipping lanes are now militarized zones. Vessels are being diverted. Naval blockades are in place. This creates what economists call a supply shock, not because silver production has stopped, but because the metal cannot reach its destinations efficiently or predictably. Now here's something fascinating. Venezuela's official silver reserves are unreported and negligible according to USGS data. 2020 production was listed at only 480 tons, with zero economically recoverable reserves listed globally, so on paper, Venezuela shouldn't matter much to global silver markets. But here's where it gets interesting. Unverified claims suggest 847 tons of silver were airlifted to China and Russia before U.S. military action against Maduro. 847 tons. That's a significant amount of silver to move in a short period, especially by air. If true, and I emphasize if because these reports are unverified, it suggests Venezuela had far more silver stockpiled than official records indicated. Why would they do this? Because silver is a strategic metal. And if you're a regime anticipating military action, you move your strategic resources to allied nations before they can be seized. Trump himself mentioned at the press conference that the U.S. would be controlling Venezuela's resources during the occupation. While he focused on oil, the same logic applies to any strategic commodity, including silver. This is where the geopolitical chess game gets fascinating. China is the second largest producer of silver globally, but they need far more than they produce. Over the past year, we've seen reports of China importing unrefined silver from Peru and other South American sources. Why does China need so much silver? Because it's absolutely critical for electric vehicle manufacturing, where China dominates global production. It's essential for solar panel production, where China produces the majority of the world's supply. It's vital for robotics and automation, which are central to their industrial strategy. It's required for the defense sector, where military electronics use significant amounts of silver, and it's necessary for 5G and telecommunications infrastructure. By disrupting South American shipping routes, by potentially controlling Venezuelan silver stockpiles, and by maintaining naval blockades on Venezuelan waters, the United States is essentially restricting China's access to a critical natural resource. According to some analysts, this is deliberate, an attempt to slow China's technological advancement by constraining their access to the materials they need most. Now remember, Shanghai markets were closed from January 1st through January 4th for the New Year's holiday. They're reopening tonight, Sunday night, January 4th. This is critical timing. Shanghai physical silver prices were already trading at a premium to COMEX paper prices. We saw premiums of $4 to $5 per ounce in late December, and that was before a major military operation disrupted South American supply chains. When Shanghai opens tonight, Chinese buyers will have had 3 days to process the U.S. military occupation of Venezuela, disrupted shipping routes from Peru and Chad, potential seizure of Venezuelan silver stockpiles, ongoing export controls from China itself that started January 1st. What do you think happens when Chinese industrial buyers, manufacturers, and strategic commodity purchasers all try to secure physical silver at the same time? Prices explode. I would not be surprised to see Shanghai physical premiums spike to $10, $15, maybe even $20 over COMEX paper prices when trading resumes. Before we go further, I need to talk about copper because it's deeply connected to this situation. Venezuela has copper resources, though not as significant as Chile or Peru. But copper is another strategic metal, essential for electrical infrastructure, telecommunications, renewable energy, and defense applications. Market experts expect copper prices to gap up alongside gold and silver. Why does this matter for silver investors? Because 70 to 80% of silver is produced as a byproduct of mining other metals, including copper, lead, and zinc. If copper mining operations in South America face disruption due to shipping route uncertainties, naval blockades, or geopolitical instability, that directly impacts silver production. So, disruptions to copper supply chains have a multiplier effect on silver availability. Let's talk about oil for a moment because it directly impacts market psychology around all commodities. Venezuela holds some of the largest proven oil reserves in the world. However, production has been severely constrained by U.S. sanctions. In 2020, production fell to just 192 million barrels. By 2025, output had recovered to peak near 1.14 million barrels per day, supported by Chevron expansion and trade with India. Trump has made it clear the U.S. oil embargo remains in place, but American companies will enter Venezuela to repair infrastructure and invest billions. The United States will control Venezuelan oil during the transition period. Here's what this means for precious metals. Oil is the canary in the coal mine for geopolitical risk pricing. If oil prices spike due to Venezuelan instability or supply concerns, that risk premium spreads across all commodities. Gold and silver benefit from this risk-on environment where investors seek safe haven assets. Additionally, according to Reuters, while PDVSA's oil production and refining operations remained normal after the strikes, the port of La Guaira near Caracas suffered damage. Even though it's not used for oil operations, it demonstrates that critical infrastructure is vulnerable, and that applies to ports used for silver and copper exports as well. Let me give you some historical perspective. Historically, when major military operations occur, gold typically spikes immediately as a safe haven asset. Silver often follows with a lag, then can outperform gold if industrial supply chains are actually disrupted. What makes this situation different is that we were already in a tight physical silver market with elevated premiums in Asia before this happened. China implemented export controls on January 1st, just days before the Venezuela operation. Major shipping routes are actually impacted, not just theoretically. The occupation is planned to last a year, meaning sustained disruption. And strategic resource control is being openly stated. The combination of these factors creates a perfect storm for silver price volatility. In past geopolitical crises, commodity spikes were often short-lived because supply chains weren't fundamentally disrupted. This time feels different because supply chains are being disrupted, ships are being diverted, and naval blockades are real. So let's talk about what to expect when markets open. Asian markets begin pre-trading Sunday night at 6 p.m. Australian markets open first, followed by Tokyo. This will be the first full trading session since Shanghai's holiday. Based on a decade of watching these markets, I expect an initial spike Sunday night into Monday morning, with gold potentially gapping up $30 to $50 per ounce and silver gapping up $3 to $7 per ounce, accompanied by dramatic moves in physical premiums. Volume may be lighter due to weekend trading. During the Monday session, emotional buying often kicks in. Fear of missing out brings in leverage buyers, media coverage intensifies, and retail participation increases. This phase often produces peak prices. In the days or weeks that follow, corrections usually occur as emotional buyers exhaust themselves and profit-taking begins. Prices can correct 30 to 50% of the initial spike. Eventually, markets establish a new normal, with prices settling at a higher baseline if supply disruptions persist. Now let's talk about what this means for different investors. If you're holding physical silver, this should increase your confidence. Physical silver becomes more valuable when supply chains are uncertain. Do not panic, sell into volatility. Think long-term. If you're trading futures or paper products, you're playing a very different game. Gap-ups can be opportunities or traps. Leverage during geopolitical events is extremely dangerous, and stop losses may not protect you. If you're considering buying physical silver right now, dollar-cost averaging remains the most rational approach for long-term holders. If you're trying to trade the Venezuela news, understand that you're speculating, not investing. If you don't own any precious metals, view this event as a case study in why many investors maintain allocations to gold and silver as insurance against unpredictable events. Zooming out, this Venezuela situation fits into a broader strategic realignment. We've seen China accumulate gold, BRICS nations discuss alternative currency systems, export controls weaponized, and trade tensions escalate. Silver sits at the intersection of monetary history, industrial necessity, and strategic competition. There are still major unknowns. We don't know the true size of Venezuelan silver stockpiles. We don't know how long shipping disruptions will last. We don't know how China will respond. We don't know whether further military actions will occur. And we don't know how stable the year-long transition period will be. After analyzing this situation, my personal approach remains unchanged. Short-term volatility is likely. Medium-term price baselines could rise if disruptions persist. Long-term fundamentals remain bullish, but the path will be volatile. I continue to dollar-cost average into physical silver. I don't view geopolitical events as trading opportunities. I view them as validation of why physical metals matter. So here's the bottom line. What happened in Venezuela is significant. Gold and silver prices will likely rise in the short term, possibly with dramatic gap-ups. But more important than Monday's price is the broader reality that strategic resources are being weaponized and supply chains are fragile. Silver is becoming more strategically valuable, not less. My goal isn't to hype you, it's to help you understand what's happening so you can make informed decisions. Let me know your thoughts in the comments. Do you expect a brief spike or sustained price elevation? Are you buying now or waiting? If you found this analysis valuable, like the video, subscribe, and hit the notification bell. I'll see you in the next analysis.